Welcome to Barchart's weekly series of webinars designed to help you, the investor trader, better understand a variety of trading ideas and concepts, as well as the pages and tools Barchart provides for you to help you make a more informed investment decision. Today's subject, exit strategies. The Greek storyteller Aesop is once quoted as saying that affairs are easier of entrance than of exit, and it is but common prudence to see our way out before we venture in, and which is so true of trading and investing. So many traders today are only concerned with their entry into the market and not or give very little time to their exit, and which is a disaster in the making for all trading. Hi, I'm John Rowand, and today we're going to look at some uh, the key component to any trade plan, and that is the exit strategy. And without a well-defined plan for exiting a market, will never be successful. With me today is my partner and our moderator, Ms. Jean Baker. Hello, Jean.
Well, good afternoon, Mr. Rowand. How are you?
Very well, thank you. I'm excited for today's session. Did you like my Greek philosopher impression there?
Perfect, John. You nailed them.
Yeah, maybe I may need a better exit plan when it comes to doing comedy or philosophy, I guess. So let's get started. Just again, as we start all of our sessions, I just want you all to realize that, all trading has form of risk, and the material that we are going to present for us today is for educational purposes, and that you should understand how risk affects you. Uh, what is it in light of your finance? And we always recommend that you um, seek the advice of a qualified financial um, professional. So for today in particular, we are going to talk a lot about risk and rules of risk, and that there are some universal elements in terms of risk that we can look at today, but also a lot of the things that I'm going to present to you is just suggestions or ideas or food for thought that come from my own personal experience, that come from inputs that I have gotten from my mentors that I found to be successful. And there's no guarantee that in the future that those things that I have worked for me are going to work for you, or that the way that you look at risk or how you define risk might be a lot different from the way I do. Okay. All right. So let's just briefly revisit one of the more important concepts that I introduced to you all in our session back in December, was how to build a better trade plan. And that rule is that rules of risk need a purpose. And we talk about these three purposes, right? The first is we need to eliminate risk, or our rules of risk. Now, we can't eliminate all risk, but the point being here is that how can we define a trade without being able to define our risk? And so all of our trades start with a stop. How much am I going to risk, or how many contracts are going to take, or how long am I going to hold a position, right? How am I going to manage that risk, right? So let's keep it simple. Let's use math, right? We'll use ratios, we'll use absolute values, we'll use percentages. And finally, what measures or adjustments that will allow me to lock in, take off, or just plain put money in the bank? Profits, right? For most traders who fail or struggle with success is because they haven't learned how to lose. And losing is part of trading, right? So what I want you to understand is that once you learn how to stop losing big, then winning becomes a lot easier, right? So all of our rules need to be non-emotional. So I hear this a lot, right? Right? Letting, your losses run. That is not a good rule, right? Oh, the market will come back. It always comes back, right? The market always goes up, right? Or adding to a losing position, right? Oh, if you liked it at $20, you got to love it at $10, right? That's not what I'm talking about. Or I love this one. I'll get out when I'm in doubt, right? These are not plans, right? And these are all emotional responses. So we're going to look at rules that are non-emotional, right? And that all of our rules need to have details, very detail oriented. We're going to have disciplines, and we need those documentations. So that's kind of a quick review of what we talked about in that previous session of how to build a trade plan. So let's move forward from this point. All right. Okay. So all trades start with a stop. This is going to be our pre-entry exits. This is what we're talking about, exit strategies. I'm going to devise an exit before, as Aesop said, before I even venture in, right? So what are some steps for selecting a stop? Well, first of all, how much am I going to risk, or how much am I going to invest, right? First, let's talk about just using an absolute value, i.e., in this example, maybe $5,000. What I want to do here is I want to be consistent about how my initial investment is, right? I don't want to pick out one investment and say, oh, I'm going to put 10,000 in, and then the next time I find a stock and I only put in 1,000 in. That 10,000 investment, let's say, loses 50%, but the $1,000 investment goes up 400%, right? I'll still be down, a net down on that trade. So I want to be consistent. I would rather under risk and add to a winning position than over risk and take a big loss. And that's why I want to be more consistent. What percentage of my risk capital will I use, right? That bucket of dollars that I'm going to use for investing, or a percentage of my portfolio, that bucket of dollars I've already invested, right? So there's 2 points here that I want to make, is that we're not going to go all in on every trade, right? And diversification is definitely the key to long-term results. But don't take my word for it. Let's learn from professionals. So I'm in ETFs for the moment here, under popular ETFs, and I'm just going down to specialized. So if any ETF would be, overemphasized maybe to one or a couple stocks, it might be one of these specialized. So I'm just going to go to the first one, home builders. And let's see what this fund manager does in terms of diversification. And these are all the stocks that they own in this ETF. And notice that percentage that I showed in that slide, between 2 and 5%, is common to our large institutional investors, right? They don't over bet on one stock, right? They diversify. Their portfolio is spread out over, this particular one, 38 stocks. And you can see on average about 3 to 4%, maybe 2% on the downside. So this is a good rule for you in terms of how you start to get into or start thinking about how we're going to set our risk, all right? How much am I going to risk, or how much can I draw down for? How much am I willing to allow myself to lose before I admit that I'm wrong? Again, I can make it very simple. I can just make it a dollar amount. I can make it a percentage of my investment, 10%, 15%, 25%, maybe as much as 50%. But if I lose half of my investment, I'm probably wrong. So I probably need to have some kind of rule that tells me that I'm wrong and I need to get out. We could talk about a percentage of price movement, maybe in terms of a technical point, maybe a recent high. So in our rules of risk, this value could be a percentage from the top. It could be based on over time, or it could be based on how far price has moved from a low, right? But what I need to do here is I'm going to need to define the difference between a correction and a downtrend, right? And that might need some other rules. For instance, I might define a downtrend or a beginning of a downtrend is if my market makes a new low or lower low, or a lower high after making a higher high, that could be a signal to me that we're in a new downtrend. But if price pulls back 5 to 10% from a recent high, but doesn't fall below a recent low, then this is a correction. So percentage price stock movement, you still need to have some more defined rules in terms of refinement, in terms of how you define if you are in a downtrend or a slight correction. All right, so we're still in our pre-entry exits. Now, the next set of exits that I'm going to define is my targets, how I'm going to start looking at my risk to my reward. So how will I determine if I'm having a successful trade? Or how can I set a target that I believe will define a successful trade? So we could talk about reward to risk ratios. Again, very simple rule here. Let me just pause here for a second. I want to give you guys a very simple formula to success. So if you want to get a little bit closer so you can listen here, here it is. Smaller losses, larger winners. That's it. That's the success. That's the formula. If I set out and look for trades where I always get at least, or I'm picking a target of at least 3 to 1 or better, and I have a win-loss ratio. In other words, I have a winner and a loser of 50-50. One winner, one loser, one winner, one loser, one winner, one stop up. And I have that 3 to 1 risk reward ratio. When I set targets at 3 to 1 or better, I will have a successful formula. I really hate watching these TV shows where the pundits come on and they say, oh, well, here's a trade, and I'm going to take a 1-to-1 risk reward ratio, right? It makes my skin crawl when I hear stuff like that. What I want to avoid is getting a lot of small winners and taking one big loss, right? This is why we need rules, right? So I'm not only going to take trades where I can find some greater rewards to my risk. My return on investment, right? So again, I want to make this very realistic and not fantastical, let's say. I don't even know if that's a real word, but it might be. And if we think about the stock market in general, for years, the average market return was somewhere in that 7 to 15%, maybe as much as 20%. That was kind of normal, right? In recent years, what we've seen is, whoops, hang on, let me get rid of that. In recent years, and especially this last year, we've seen some extraordinary results in the S&P and some stocks. So, matter of fact, I don't know if you guys knew this, but in terms of the March low from last year, is the third largest price movement or gain in the history of the stock market or in the history of the Dow. And the only other two other times that have been greater was 1929 and 2009. So there could be this kind of mean regression over the next few years where we'll get more normal results. But you can see again here, for the S&P in terms of performance, the last month it's up 5%, the last 3 months it's up 10%, the last 6 months it's up 28%. So I think these are kind of a little bit on the high end of what we normally think about. So again, we want to kind of be realistic about when we look for return on investments. So one rule you could use when the market returns to what I would consider more of a normal return is just try to beat the street. Set out a goal to say, hey, I want to see if I can beat the street. And if your trade plan or your formula is not beating the street, then you're probably better off just trading index funds. I know that's kind of boring sounding, but they are doing what the market is doing. So think about that. All right. A structure when we look at our charts, right? So we're going to talk about the path of least resistance, right? I'm going to set a target that is in my trend time frame where I believe that there's going to be some resistance or a speed bump that's going to slow down price for me. Or I can look in a secondary target at a higher time frame to give me even a greater risk to reward ratio or reward to risk ratio. So let me show you a great example of that. So here's not IBM. This is 3M, and here is a trade that I was looking at. Here's a nice explosive candle that broke through a recent pivot high, and that's kind of one of my signals that I like to look. And then another candle that took price above this high. So I'm going to wait for a retracement into an area between these two green candles, these explosive candles. And that's going to be my area of risk as well as my area for my entry. So here price came back and gave me an entry. And that entry was around $1.88. My risk to the downside was how far I will say I will allow this market to go before I'm wrong. Looks like it's about $2.30. If I added, let's say, 20 cents of a buffer to protect myself from those nasty algorithms that are trying to stop us out in common areas where stops generally cluster. So I'm not risking $2.50. Well, if I'm only going to try to get a 3-to-1 risk reward ratio, then I want to make at least $7.50. So if I add $7.50 to $188, that puts me in around $95.50. And before, right, let me slide this over here. Whoops. I have my entry and I look up and to the left. Do I see any resistance? Do I see anything for me to be concerned about, right? Is there anything over here for me to be concerned, especially around that 3-to-1 risk reward ratio? And yeah, I don't see anything at this moment of time when I'm setting this trade. But we talk about this path of least resistance. So now we can set a secondary target, and that secondary target could come from a higher time frame. Now I've gone to a 5-year chart, but it's a weekly chart instead of a daily chart. And here you can see that we do have a lot of room for price to run, right? There's really not much here in terms of resistance. And how do I define success? Well, if I can get $20 out of this trade right around this 208 area, that would be a 10% return on price appreciation. If I capture $20 off of this price movement, is that a successful trade? So setting a realistic target, but also looking for greater risk rewards at higher times to get us those big wins that we want, right? All right. Swing traders, and now I'll define swing traders as somebody who will own a position maybe for 1 week at a time, a few days at a time, to maybe week to week. You could set a goal of or a target of maybe 2 times your average true range. Examples I gave here is 9-day or a 20-day. If also, we could talk about a percentage of price. Again, this could be off of a very significant technical low or a technical high. In other words, let's say you could say, my market has been in an uptrend and it's up 70% or 50% from year to date, from the low of the date, and I've caught 20% of this uptrend. Well, is that a successful trade, right? How much of that price appreciation have you captured? So be realistic, but some food for thought. Okay. All right, so let's shift our focus now. So how we can start managing our risk, right? Our post-entry exits, right? After we're already in the market. So I'm in a trade, right? And our first objective is to move our stop loss to stop break even, all right? And again, this is a common mistake many traders do, is that they let a winning trade turn into a losing trade, right? For instance, let's say my trade is up $500, right? And I don't make an adjustment to my stop loss of $500, and the market retreats and stops me out Most would say that they lost $500. No. KNOW, no. You lost $1,000, right? Giving ourselves permission to eliminate loss. Remember our rules of risk, right? Giving ourselves permission. And now, how can we start to move forward to manage our profits? Okay, so this one does take a little bit of patience, right? I want to think about time. I just don't want to jump into break even when market starts going my way. So we're going to keep it very rule based. Time, right? How long am I going to wait for the trade to bake, right? Day traders, it might be a couple hours. Swing traders, might be a couple days. Wealth traders, wealth builders, you might wait a week or a month before you start making that break-even adjustment, right? Violates structure, right? And again, this will be off of our charts. What I'm going to do here is every time my price goes above an area of resistance or where I believe an opposing area, that would give me permission. If I can get past that first area that's in my trend time frame, that would give me permission to move my stop to break even. So here's Coca-Cola, and I've identified two areas of resistance or opposing zones, I would call them. And again, very typical type of trade that I like is I like to see an explosive move that breaks out above a previous high, and there it is, and then I wait for that retracement, and so that would be this blue line would represent my entry, and maybe my stop would be, probably somewhere down about there. So now price moves up, right? That represented here, and it gets above this area of this opposing area. That would give me permission at that moment when this candle went above here, that would give me permission to move my stop to break even. Okay, let me just move it a little bit above here. But again, as we move forward, as I'm being able to eliminate risk, I've eliminated risk of this trade, but now I'm also going to look at ways to manage my money. And we're going to go a little bit deeper in here. But when price breaks the next area of resistance or comes into that area of resistance, that could give me also another rule that allow me to move my stop from break even to profitability. And we'll work on that in a second. All right. Thresholds of probability. These could be numerous. That could be depending on how you look at the market. Again, that reward to risk ratio. And again, we're not taking off our trade. We're just using that as permission to move our stop to break even. If I get 1-to-1 or I get 2-to-1 or 3-to-1, that would give me permission to move my stop to break even. If I make a new daily high, a new weekly high, a new monthly high, that could be one of my criterias. For my swing traders, if you capture one ATR, day traders, if you capture a third or a half of your ATR, all of these, I think, in together could be used in a combination. In other words, you might say something like, have a rule that says, I will allow myself to move my stop to break even if I get 2-to-1 on my reward to risk ratio and I break a new daily high or I break a weekly high, right? A combination of rules that give me that permission to move to break even. Okay, so the next thing that we're going to look at is permission to lock in profits, right? Another exit strategy, right? We're right. We picked a trend. We picked the right market. We got the market to move in our favor. We want to get paid, right? I mean, that's what we're in this business for as traders and investors, right? We want to make sure that we capture those profits, right? So rules of permission to move our stops to profit. So one very simple rule is, again, a charting rule, which is based on what is called something called a trailing stop. And there are different kinds of trailing stops out there. There's technical trailing stops, but one of the very simple one is a swing high, swing low stop. And let me show you an example of that one as well. Intel, there we go. Oops, there we go. All right, so what we're going to look at is when this chart pops up, is we're going to look at as the market makes a swing high or swing low. Now, how do I define a swing high or low? Well, it's basically, to me, is where price stops going up is a swing high, and where price stops going down is a swing low in terms of my trend. So again, let's pretend that this blue line is my entry. I saw an opportunity for price broke out, waited for that retracement, and then that was this red line here represents my stop or my original entry risk, right? Now price moves up, right? Moves up and makes a new swing high. Price goes above my previous swing high. Well, now I have permission to move my stop off of the most recent swing low, right? That was created before we made this new swing high. Now price goes back up again, or comes down, makes a swing low. Now price goes up, right? Makes a new swing high. Again, now that gives me permission to move my stop to that swing low, right? So this is what it was called a trailing stop, right? We move our stop up every time market makes a new swing high or gets above a significant technical point, a new high on a weekly, new high on a monthly, new high on a daily. Now it's important on this one and trailing stops is that we only move it in one direction, always towards current price and always to lock in greater profits. We never move our stop backwards, all right? Again, we could use time, right? We'll wait a week, we'll wait a number of days, we'll wait a number of hours before I give myself permission to start locking in profit. We talked about price percentage as a way to lock in profits. Again, maybe it could be from a low, right, against price movement. If I get a 25% movement off the low, that's an area where I want to set my stop. Something called give back or max give back. How much I'm going to allow the market to take back from the most profit that it had given me before I decide that I'm wrong or that my trend has reversed, or maybe or I just don't feel comfortable putting that profit to risk, right? And so I use 50% here. I think that would be the maximum I allow myself to give back. A lot of folks would ask me and say, hey, can I do 10%? Can I do 15%? Can I do 20%? Yeah, I think that would be fine. Just remember, the smaller the percentage or the closer you are to current price, the greater the probability is that you are going to get stopped out. But I think a good rule of somewhere, let's say a third to half of your maximum profit would be a good spot to lock in profit, right? And 75% of our original target. Again, this one can go both ways. When we go to the next segment, we talk about when we get to our targets, I can use this one. But if I achieve 75% of my original target, right, at some point, I want to have a stop in place that is a stop profit. Now, it might not be right at 75%. Maybe it's only at 50%. Maybe it's only at 30% of my original target. But I've gained that price appreciation. I want to make sure that no matter what happens in this trade, I'm going to ring the register and I'm going to be profitable, right? So let's go back to this example in Intel. And let's kind of break this trade down in terms of what I just showed you. Again, so our entry was at 53.35. That's my dyslexia coming through. And I think in this trade, the risk was about $2, right? So 51.35. So think about it. Price is moving up. I'm locking in profit. I'm doing a trailing stop. And now we get as high as around $68, right? How much of profit have I taken in? I'm taking in, about $15 worth of profit, right, on a $2 worth of risk. So I've gotten a 7.5 return, right? 7.5 return to risk ratio. where I could set my stop. I mean, I'll set a stop at a 5-to-1 ratio, or I will say how much will I allow price to come off the top. Maybe 10%, maybe 15%. That difference between a correction and a downtrend. So, think about 5-to-1. That would be a $10 profit. My stop now would be somewhere around $63 or $64.50-ish area. If I thought about a 10% correction, that'd be about a $6 or $7 correction, right? That would be down around here. Now, notice both of those stops would have already been elected, and yet if I had just waited and not made any adjustments, where would we be at today? We'd have given away all that profit that we had already made, right? Because price has now dropped. And I'm sure that this had something to do with earnings. So that would be another risk that we could talk about at some later time that we need to make some adjustments for. But just looking at my chart, that would be a way where we can employ some of those things. Think about that 75% of my original target, right? Or my higher time frame target, right? Where do I have concern? Where is that opposing resistance? Where can I give myself permission to move my stop to profit, right? 75%. Notice that where the price kind of popped off of, where it stopped over here, is right around where we would anticipate that we are coming up against resistance. We're coming up against a speed bump. So what is 75% of $15? Well, it's about $11.25. There is what I would have set my stop, because I knew that no matter what happened in this trade, I'm going to lock in $11.25 or 75% of my higher time frame target. Okay. Hope that makes sense to you folks. Again, that reward to risk ratio. If I'm getting 7-to-1, maybe I move my stop to 5-to-1. If I'm up 5-to-1, move my stop to 3-to-1, right? Every time I reach a new threshold, I'm going to make an adjustment to my stop. All right, so now the market is continuing to reward us, right? How are we going to give ourselves permission to take profits, right? And this is where Barchart really starts to help us in our executing our rules. I'm going to show you how to do that in a second. But let me give you an example here. We're going to talk about some technical indicators that we can use to help us give us permission to take profit. Not only the physical ones that I just showed you, but now some more technical ones, all right? So let me go to Verizon. And let's get this popped up. Okay, let me move this out of the way so we don't get confused. All right, so first of all, let's just look at this chart. I'm going to just give you some reference here. The purple line here represents a target that I had set out. The black line represents the upper end of that target. Let me go to a higher time frame so you can see that. Here's the price movement that we're going to look at, where we're going to dissect inside of here, but there is that higher time frame area of resistance where I have set a target off of this little price movement here. Okay, all right, so we'll go back. And so one of the technical indicators that a lot of traders look at, or one of the ones that we advocate in the bar chart, are some kind of moving average, or what we call MACDs, crossovers, right? Moving average crossovers. So these are very common ones that we can look at. What I've done is I have a template. One of my templates that I use is the 20 and 100-day moving average. And that's what I've done here, is I put this on the chart. Let me get rid of the volume here. And the green line here represents the 20-day moving average. There it is right there. And the black line represents the 100-day moving average. So you can see that our price was moving in a nice strong uptrend, a nice strong moving average, right? And we reached an area of concern, right? We've got to our target. We reached this target, right? What am I going to do? Well, I might wait and see if price comes back to this moving average. Now, the common interpretation says that when price falls below the moving average, that is interpreted as a sell signal. Now, the reason why I also like this as a sell signal is what is my moving average doing here? It's flattening out. It's actually slightly turning. It's telling me that price action is actually starting to lose some momentum. So the common interpretation would be this would be a sell signal. Now, price falls even farther, and then price falls below the 100-day moving average. Again, another common interpretation, when price falls below a 100-day moving average, that could be indicative of a sell signal. And then finally, when the two averages cross, right, that is also another common interpretation as a sell signal. And you can see that that would have been price was down here. So you can see each one of the individual sell signals give us a different exit at different values, right? The shorter the moving average, more sensitive to current price. The longer the moving average, the less sensitive. If you're waiting for two moving averages to cross over, even more less sensitive. So again, whatever rules that you're going to apply. All right, so that's Verizon. So when we come back full circle hill, you'll remember this. So let me go to, where do I want to go here? Okay, let me go to tools for a second, and I'm going to go into portfolios. And so we've created a lot of these different portfolios for a lot of our webinars. And the one that I have up here is my Dogs of the Dow. You guys are probably getting tired of seeing this one. And you do see Verizon is in here. So one of the things we can do where Barchart can help you with these technical indicators that'll help you help find these exits is I can go into my screener. And again, just to remind you folks is that we can screen now on our lists, our watch lists, and our portfolios. So that's what I have here. I have my portfolio up. I have all the different portfolios I have, and I just have Dogs of the Dow right now identified. So I could say, all right, let's look at moving averages. So I'll just type in moving averages, and there it is, 20-day moving average. I'm going to add that to my screener. Now, what I'm going to do here is I'm going to change it to, excuse me, I'm going to come back here. I'm going to get rid of this. I actually jumped one step too fast. I'm going to come over here and the 20-day moving average, add it. And actually, what am I doing wrong? I figured this field. Yes, I could look at those crossovers, right? Or I can come into down here where it says opinion indicators. And there again, there's our 20-day moving average. These are some of our opinion indicators that we have inside of our portfolio, inside of our website that you can use on individual markets. And there's the 20 to 50 day, 200 day, right? Let's add that one. And let me get rid of it. What I'm going to do is I'm not going to look at the strength of that 20-day moving average. I'm not going to look at the direction or the signal. What I'm going to look for is a new signal, right? That common interpretation. I'm going to add that. I'm going to get rid of this one here for a second. And what I'm going to do is now tell the screener, I want you to identify markets that are giving a new sell signal, that common interpretation, prices breaking below the 20-day moving average, and then show me those results. Now, this morning, now it's telling me that Merck has that common sell signal. So we'll go look at Merck right here through our flip chart, and here's my 20-day moving average. And you can see here, price is falling below. Now notice that this one actually price is already below our 100-day moving average. So this could actually be somebody who is looking for a shorting opportunity. This might be one of those ones that you could use. So now what I'm going to do is I'm going to save this screener. right? And what's going to do here is let's just call this screener, let's say webinar, right? And I could put in a description here. I'm going to say this is the 20-day sell signal, right? Just gonna put a description in there. And then what I can do is I can send this screener based on my portfolio either to me on a midday report or an end of day report. And this is a way that's going to identify to me when one of these opportunities or one of these signals or one of these rules are going to be activated that is going to make me make a decision. Either I'm going to set a stop or I'm going to get out of a trade or have to reassess my risk, right? And I can send that midday and then save that and send that to me, all right? Now, once you save that, you will be able to find your screener. And I do have a sell signal screener right there, which is my 20-day moving average for my dogs of the Dow. And you can see it did give me that Merck signal, all right? Okay. So let's go back to filters here. And I want to show you some other ones that you could use. They're just kind of food for thought, not necessarily this technical one. But one of the things we could look at, let's say, is highs or lows. And here we're going to go down to where it says new low date. And what we're going to do here is we're going to get the screeners to start looking at new lows based on a time frame for us. And I can pick the time frame that I want to see what a new low would be created. So let's say a 1 month low. I want to know if a new 1 month low is going to happen. So I'm going to add that. And again, I'm going to come down here, made within the last session. In other words, today, or 2 sessions or 3 sessions, or I could even say in the last week, have I made a new low in monthly low in the last week? And again, if I do my dogs the Dow, you can see that several of my stocks here that I have are showing me that I am making a new monthly low, and I made that in the last week. And these are the dates when those new monthly lows were made. Again, that could be a signal for me to exit a trade, or been a signal for me to move my stop or make some kind of an adjustment to that trade. All right. So we don't always have to think about terms in terms of where we're going to get out and lock in profits as a bad event, as price moves away from us, right? Sometimes we can start thinking about where we're going to make adjustments to our stops when we have good results, right? Where market is rewarding us, right? And so one of the ones we could think about is gaps, right? And not necessarily gap downs, but that certainly could be one of the aspects we could think about, but gaps up. Maybe I'll say to my screener, hey, create a screener for me where I want you to show me my portfolio of my stocks of markets that have gapped up 3% or 2%, right? That's a good thing, right? That would give me permission to do what? Move my stop into a greater position of profit, because we're probably believing that once we get a gap up, that price is going to continue to move in that direction. So I can use these screeners not only to find where places to tell me where to get out when the market is going against me, but also start thinking about where I can make adjustments to my rules of risk, or actually start thinking about the next thing, some different technical analysis that will actually give me permission to ring the register right there. Now, Bollinger Bands is one of the ones that I use, and this might not be one that you are familiar with or have experience with, but let me see if I can make this one a little bit clearer for you. All right, so let me go back to, let's pick a stock here. And we're going to go to the chart page. And Bollinger Bands is a theory of standard deviation and price movement. And there's a lot of different interpretations. Some look at as price breaks out of a range as a way as a buy signal or a sell signal. Others look at Bollinger Bands in terms of a contrarian signal, a sell signal, or a buy signal when price gets too far or deviates outside of the Bollinger Bands. So the rule here, or listen, the math here, is that the upper and lower bands represent a 2 standard deviation. So if I give you the math on that just quickly, is that less than 5% of the time does price deviate outside of 2 standard deviations. So it's a rarer occurrence, not uncommon, just rare. And that this could give us permission to sell out or to ring the register when price gives us one of these short-term extraordinary price movements. We're not going to look at Bollinger Bands when they are bandwidths are narrow, but we're going to look at when Bollinger Bands are wider, right? The bandwidth is wider. And the common interpretation on this one is that when price goes outside of the Bollinger Band and then comes back inside the Bollinger Band, there's a higher probability it's going to what they call mean reversion. It's going to go back to this middle line, which is the mean. So this would be an opportunity for me to say, hey, I could take profits because I'm seeing an extraordinary price movement in a very short period of time. I'm going to ring the register right now, right? A good thing, right? Giving us permission when the market is going good, right? Maybe in this case, or in the next example I'm going to show you, when it's going too good. So here's one of those cannabis stocks that get caught up in that big price movement all the cannabis stocks had earlier in the year. And again, let me put up my study, my Bollinger Band study here. And right there is that big pop in price, nice uptrend, right? I'm not worried about it. I'm moving my technical stop, moving my trailing stop, locking in profit, right? Boom, big price movement. Not only did price move really far in a very short period of time, but it went way outside my standard deviation. That could give me permission to sell out right at that moment, especially if my price target is an area of concern at my higher time frame. So we can use these signals as well as not to tell us when something bad is happening, but we can also use these signals to tell us when something good is happening and give us that permission to lock in profits, or in this case, take money off the table, because there's no guarantee that when price does one of these crazy price movements, that it's going to continue to go in that direction. And as a matter of fact, you can see that in the next day, price actually fell almost $15 in one day. All right. Before I go to the next one, I do see a couple questions that have popped up. I do want to try to answer a couple of these questions. How are we doing on time, Gene? We're doing really well on time. Good. All right. So let me see here. So Muhammad asks, how do you avoid selling too early? Well, Muhammad, I think selling too early is invoking an idea of emotion, right? If you have already designed a trade and said, hey, if I get this result and I get this reward and I'm going to take that profit, then if the price continues to go back up, that's fine. You could look for another opportunity to get back in a trade. Why can't you go to the same well that you draw from before? Yes, maybe you've given away a little bit profit on the next leg, but what I'm hearing here is emotion, and I don't want to think about emotion. If I have a successful trade, I ring the register, move on, look for another trade. Does that mean that I could come back into that trade? For sure. All right, so we have a question here about trailing stops. So the question, doesn't the platform automatically adjust the trailing stop when price rises? So our platform does not, but some trading platforms will use what is called a technical trailing stop, which will allow you your stop to be moved up. Now, that's a great point here, is that just because what we're doing on Barchart doesn't mean that those are actually where your stops are in. Your stops, or real stops, are going to have to be put in with your broker or your trading platforms. We're using Barchart as information to help us to identify where we're going to place those stops. But many trading platforms I've used and seen will allow them to automatically make those adjustments. Those are called technical trailing stops, all right? So yes. Danielle asked a great question, and Danielle, this is something that we're going to explore in other webinars in terms of trade plans. But she asked a question about, can you ever sell a small portion of your position as you get to one of these targets, or as you're making new highs? Yeah, Danielle, that's a great strategy, right? I don't sell out my whole position. Maybe I sell half my position, lock in that profit, and then move my stop to a position of break even. Now I have a risk-free trade, and I know no matter what happens in that trade, I've made a profit, right? So that's a great way to trade. That would be a little bit more advanced subject. We'll definitely look at that in the future. So let me ask see a couple more questions here. James Foster asks, in the early innings of a trade entry, you can create stops X times percentage below the entry price, but sometimes trades go well and beyond a conceivable profit potential. Say you make 50%. Did you give 50% back? And if you gave back doesn't happen, let's say you go even higher, oh boy, James, if you were taking profits at some point, would you add to it, or would you just consider this a new trade? So that's, again, I think that's kind of what Danielle is asking, is I think you have to think about each trade. Anytime I enter the market, anytime I put money to risk as a new trade, could you combine positions and get like an average value or average price value? Yeah, you could do that. Could you use the profit of one trade to finance a second trade? Yeah, these are more advanced techniques, and yes, you could do that. All right. Okay. So good questions on both Daniel and James. All right. Okay. Let me get rid of that one. And I do see a couple others. I'll see if I can get back to those. All right. I'll come back to my slides. All right, and here's my personal favorite rule of risk in terms of giving myself permission to take profit. And I call this one the 3-candle count back. And so let me go back to that Verizon trade. That we did with the 20-day moving average. So I'll only apply this rule of risk when my price gets to my price target. In other words, kind of what James is saying, hey, I've gotten this big reward, I don't want to get out of this trade because I feel like this could continue to go, right? Or that, I'm going to eliminate that emotion that I'm getting out to her, right? Which what Muhammad was asking. So what I'll do is I will look at price as it is being developed, okay? And so again, here we see this candle. Let me make this a little bit wider for you, okay? So here is a candle that comes into my area, my target area, right? This is what we call our developing candle. And what I'm gonna do is I'm gonna count back 3 candles. 1, 2, 3, and I'm gonna raise my stop just below the lowest of those 3 candles. Then that candle is going to close and another candle is going to be created. I'm going to count back 3 from there. 1, 2, 3. Notice that I cannot adjust my stop. It's still the lowest point of the last 3 candles. All right. Now I'm going to go to the next candle. So I'm going to count back from this one. 1, 2, 3. Now I'm moving my stop just below that candle. Now I'm going to the next candle, right? I'm going to count back 3. 1, 2, 3, right? And that's where I have my stop. And then the next candle, boom, stops me out. At this point, I don't care. I don't feel remorse, right? Because what has happened? My price has gotten really close, has got into my target area, and this is where I don't want to give back anything, right? I'm going to either make my full target, or I'm going to make 80% of my target or 75% of my target. Both good things, right? Now, again, if we follow this forward in time, right, there was that big price explosion to the downside, which was kind of right in the same area where we would have set our stop. Now, we would have gotten stopped out a little bit earlier, but that's okay. That's a good thing. Now, what I also did say is that I will use higher time frames a lot of times to set a 3-candle countback. So in other words, so I might use a weekly chart, for instance. Now, one of those stocks that recently just had a big price movement based on its earnings was this 3M example that I gave you this morning. And again, this is a kind of great example of, right, a big drop in price. Well, I know if I go to, let's say, a weekly and I count back 3 candles, right, then I would have been stopped out around $94. Looks like 194. So that's where I got stopped out. Okay, now where's price now? Well, price is now back above $94. That's okay. I'm not going to be emotional about this. I use these protective stops to lock in profit. But what could I do now? If I believe that these 2 candles or this price action is the beginning of a new up leg, then I could set about my rules of risk to allow me to take a re-entry into this trade, and maybe I can capture this price movement on the way back up. But I'm not going to think about what had happened because I've already set my rules in place and they've already exited me on that trade. All right. All right. So let me ask you more questions before we get to our takeaways. All right. Gina, is there any questions that are up there that are kind of common?
Well, one of the common questions I've been answering for people, they're asking whether the free subscription allows for the screening tools that you've been showing. And my answer to that is, you can sign up with a free membership with Barchart, and you can use the stock screener as John was demonstrating. Some of the features that he showed you, though, like being able to send yourself an automatic email of your screener results, those are premier features. So here's what I would suggest to you. If you don't have an account with Barchart, sign up for a free account, look at the screener, and once you get comfortable with that, we offer a free 30-day trial to Barchart Premier where you can really dial into some of these automatic screening features and notifications and alerts to know when your symbols reach a new buy or sell signal for one of those bar chart indicators that John was talking about. So that's the common question I've been answering, and hope everybody can take advantage of a membership here.
Cool, excellent. Yeah, I would definitely recommend that, folks. It's just, why wouldn't you use use as many tools as possible to make yourself more successful? So I see a lot of questions are kind of one about certain kinds of candlesticks, and Wayne, yes, those candlesticks eliminate a lot of false breakouts, and they're more about internal moving average or moving price momentum inside of a candle. So yeah, you can use different candlesticks or different charting patterns. Dimitri asks, excuse me, Peter asks about you still have an opinion that it says a strong buy signal. but you've reached your reward. What would you do? Again, Peter, I would move my stop to a position where I know that I've locked in profit, and I'm going to try to let that profit run, right? I'm going to let that profit run. But what I'm not going to do is let that market reverse on me, like we saw in that example of 3M, and drop $15 overnight, right? So I want to make sure that I get is locking as much profit as is, or as in Daniel's case, maybe with once I reach one of those goals, those higher time frame goals, or those greater reward to risk goals, I'm going to take a little bit money off the table, right? And then Wayne asks, for the 3 candle stop price raise approach, you are using the lowest price of the candle, the closing price of the candle's day. Wayne, it's up to you. It doesn't really. I prefer to use the lowest price of the last 3 candles. Um, and if you think about it, if we're using it in a higher time frame, let's say a weekly time frame, to do that adjustments, what I'm really saying is I'm looking for price to make a new almost monthly low, right? 3 weeks, right? Developing candle and 3 back, I'm looking at a new monthly low. So that's how I kind of looking at that. 3 days, yeah, it's not a week, but that's kind of how I developed that, right? So 3 days is a week, 3 weeks is a month. I know it's not exact, but that's kind of what we're going for. And so Katie asks, will the 3 candle system work for swing traders? Yeah, again, okay, you could use it on a weekly basis. You could use it on a daily basis, right? Those would be what we would consider higher time frames. But if you're a swing trader who's trading from week to week, like Monday through Friday, and maybe you're looking at your trend time frames at like an hourly time frame, then maybe you could use a 4-hour time frame, right? Or for my day traders, if you're using, 15 or 30 minutes or 60 minutes as your trend time frame, then I would use a 3 or 4 multiple. If I was using a 15-minute trend time frame, I'd be looking at an hourly, a higher 3 candle countback. If I was looking at an hourly moving trend time frame, then I'd probably be looking at 4 hours or maybe a daily. So yes, Kate, definitely can use it in a swing technique. Okay. All right, so let me do this. We're right at the top of the hour, a little bit over. I apologize for that. So what are some of our takeaways, right? Make our rules count, right? Follow through, trade your plan, right? Set your plan out, trade you. Learn from your mistakes, learn what works, learn what doesn't work. Come back and make the adjustments after the trade, right? If you got stopped out too early, Mohammed, then your rule next time it says, I'm going to look for that second higher target, or I'm going to look for a greater reward to risk ratio. Make sure the purpose of my rules, right? What are my purpose of rules? Those 3 purposes: eliminate risk, manage my risk, and most importantly, when the market rewards, make sure you find a way to take profits and not let the market take it back from you. Remove emotion from your plan, right? We don't want to think, oh, I'll get out when I get out. The market's going to the moon, right? That is not an exit. Hard and fast, right? I want to have concrete rules where I can react. Don't have to think. I already did the thinking. I'm going to react hard and fast. Allow Barchart to help you execute your rules. Use these screeners, use these technical indicators, use these charts to help you set your rules, execute your rules. And a well-executed plan of exit builds confidence, and it builds your portfolio as well. So I hope you guys liked that one. This is one of my favorite subjects to talk about because I really feel that this is one of the parts of all trading plans that many traders suffer with or struggle with. And these simple rules, these simple concepts will put you on a path or that formula of success. All right, so I know Gene's going to ask me to do this. Let's go back to our main page, right, Gene?
That's right, John.
As we're running out of time here. And Again, under tools, all of our webinars are recorded, and this one will be recorded, so you can go back and listen to this one as many times as you want. They are free. I did want to point out before we talk about next week is there are a lot of different categories, and then here under developing a new trade plan is that one that I had mentioned in the beginning, successfully building a trade plan. Gene, nice work on this. I like you kind of threw me a curveball. It was at the bottom of the page last week, and now it's at the
Right.
top. So
Reorganized a little bit, did some house cleaning. Hopefully it's a little bit easier to find the content.
what I know what this is telling me is that you're going to ask me to do more trade planning things because how high it is in our priority. Anyhow, next week we're going to look at how to tap into the power of our custom views. We have a lot of data tablets, tables. We have a lot of information that is provided for you on the website. And here what we're going to do is we're going to customize that data to help us refine or pinpoint those ideas or analysis that are more important to us, and kind of use this analogy of looking for that needle in the haystack or finding the diamond in the rough, taking a big large data set and then shrinking it down to what is more important to us and how we can use, again, that in bar chart, execute our trade plan, make us aware of these opportunities, but also how to notify us of these opportunities. So that'll be for next week. Anything else, Gene?
That's really it, other than to thank everybody for paying attention to John's excellent presentation today. We've gotten a lot of really nice comments from you in the chat window, so I'll be sure to pass those along to John as well. And thank you from
I'd
me.
want to
And
thank you.
go ahead.
Exactly. Go ahead.
No, I just want to say thank you to everybody for attending, and we hope to see you next week. Thanks again for using barchart.com. We appreciate it.